Every year, the ATO does something remarkably helpful. It tells you exactly where it intends to look. It publishes its compliance priorities, names its focus areas, and then spends the year auditing accordingly. The taxpayers who read that list and act on it consistently have quieter years than the ones who do not. I am Benedict Youn, tax lawyer at Australian Tax Experts. In this presentation, we will walk through the key ATO compliance risks heading into the new financial year: offshore income, trust distributions, rental deductions, work expenses, the cash economy, and the biggest employer change in a generation, payday super. Let us take the list seriously together. 4 numbers sketch the year ahead. 6. The focus areas we will cover: offshore income and assets, trust distributions, rental properties, work-related expenses, the cash economy, and payday super. 100 plus. The jurisdictions now sharing financial account data with the ATO automatically under the Common Reporting Standard. If you hold money overseas, assume the ATO can see it. 7 days. The new payday super deadline. From the 1st of July 2026, contributions must reach employees' funds within 7 business days of each payday. And 9 in 10. Roughly the proportion of rental property returns the ATO's own review work has found to contain errors. Overwhelmingly, errors in the taxpayer's favour, which is exactly why the ATO keeps looking. First, offshore income and foreign assets, still at the very top of the ATO's list. The context has changed permanently, with more than 100 jurisdictions exchanging financial account information automatically. The ATO has unprecedented visibility of foreign accounts, balances, interest, and dividends. The offshore compliance work focuses on undisclosed foreign bank and investment accounts, unreported foreign income from employment, business or investments, foreign trust arrangements, and significant unexplained transfers into Australia. If any of that describes your position, the advice is simple and urgent. Move first. A voluntary disclosure made before the ATO makes contact is the difference between a manageable correction and a genuine crisis. And with the data already flowing, waiting is not a strategy. Second, discretionary trusts, where the landscape shifted just weeks ago. In June 2026, the High Court decided Commissioner of Taxation v. Bendel, holding that unpaid present entitlements are not Division 7A loans. A win for taxpayers, but not the end of trust scrutiny. Quite the opposite. In its decision impact statement, the ATO expressly pointed to Section 100A and Subdivision EA as its remaining integrity tools for trust arrangements involving corporate beneficiaries. The arrangements at risk are familiar: distributions to family members on low marginal rates, where the economic benefit never genuinely reaches them. With the ATO's Section 100A guidance now battle-tested, trustees should review both their distribution history and this year's plans with their advisor, before distributing, not after the audit letter. Third, rental properties, a perennial and for good reason. The ATO's review work keeps finding errors in the vast majority of rental returns, overwhelmingly over claims. 3 mistakes dominate: repairs versus capital improvements. Fixing a broken fence panel is a repair. Replacing the whole fence is capital, deductible over time rather than immediately. Apportionment. A property available for rent only part of the year, or used privately part of the time, needs its deductions split accordingly. And loan interest. Where borrowed money was partly used for private purposes, the interest must be apportioned too. Interest remains the biggest single number in most rental claims, even with rates easing from their peaks, and the biggest number naturally attracts the most ATO attention. Fourth, work-related expenses, the ATO's highest volume compliance activity for individuals. Every claim you lodge is compared by analytics against what others in your occupation at your income level claim. Sit well above the pack and your return is flagged. Home office claims deserve particular care now that working from home is permanent for so many. Use a recognized method. The fixed rate of 70 cents per hour is the simplest, but it requires a contemporaneous record of the hours you actually worked from home, not an estimate reconstructed in June. And do not let private expenses creep into the claim. If you are in any doubt, review the claims with an advisor before lodgement, or amend promptly where overclaiming has already happened. Small numbers, but easy audits. The ATO runs thousands of them.
Fifth, and if you employ people, this is the one to act on this month. Payday Super. From the 1st of July 2026, the superannuation guarantee regime changed fundamentally. Employers must now pay super at the same time as salary and wages, with contributions required to reach employees' funds within 7 business days of each payday. The quarterly cycle that businesses have built their payroll and cash flow around for decades is gone. The risk is mechanical. If your systems have not been rebuilt for the new cadence, you will fall behind without meaning to. And late super becomes the superannuation guarantee charge, with interest and administration fees, none of it deductible. Add the fact that general interest charge is also no longer deductible, and the arithmetic is blunt. Falling behind on employer obligations has never cost more. Review your payroll now, in July, not when the first shortfall letter arrives. Sixth, the cash economy, now run under the ATO's Shadow Economy program and powered by an ever-widening data net. Banks and payment processors, government agencies, and digital platforms all feed the ATO's data matching engine, and card takings are reconciled against declared income automatically. The sectors in the spotlight have not changed: hospitality, construction, and personal services. For businesses in those industries, the practical tripwire is the ATO's small business benchmarks, financial ratios drawn from everyone else's returns. Results outside your industry's range raise your risk profile all by themselves. The defense is unglamorous but effective. Thorough records, daily reconciliation of cash to sales, and reporting that stacks up against the benchmarks. So what do you actually do with the ATO's list? 5 reviews, best done in July rather than next June. 1. Offshore interests. Identify any foreign accounts, income or assets not fully reported, and take advice on voluntary disclosure. 2. Trust distributions. Test this year's plans and your distribution history against the ATO's Section 100A position. 3. Rental claims. Repairs versus capital, apportionment, and loan purpose. Checked before the ATO checks for you. 4. Payroll. Confirm your systems and cash flow can deliver super within 7 business days of every payday, because that obligation is already live. And 5. Business records. Bank to BAS to benchmarks, reconciled and consistent, keeping the data matching quiet. An hour with your advisor on each of these now is the cheapest insurance the tax system offers. Notice the pattern across everything we have covered. The ATO tells you where it will look. The taxpayers who fare worst are almost never the ones with the most complicated affairs. They are the ones who heard the warning and did nothing. So the path is simple. Know the focus areas. The ATO publishes them. Take it at its word. Review your exposure honestly against each one. Fix proactively corrections, disclosures, and system changes made before any contact from the ATO, when every option is still open and every concession still available. And then face the year with confidence, managed risk, better outcomes, and no surprises. Proactive is cheaper than reactive in this system, every single time. At Australian Tax Experts, tax lawyers and accountants work as one team across every risk on this year's list. We run compliance risk assessments, a confidential review of your exposure across offshore holdings, trusts, rentals, payroll and business records, mapped against the ATO's current priorities. We manage voluntary disclosures, offshore income,
trust issues, and past errors corrected on the best available terms before the ATO forces the timetable. And if the ATO arrives first, we run the audit defense, from the first letter to the final outcome. The new financial year is the natural moment to know exactly where you stand. We can tell you, confidentially and quickly.
If your business or personal tax position may be exposed in any of these focus areas, contact Australian tax experts for a confidential risk assessment and peace of mind for the year ahead. Visit australiantaxexperts.com.au/contact. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.